We think we know what a bank is, a solid, dependable building, a place of safety. We imagine our savings stacked neatly in a vault, guarded by steel doors. But this comforting image is an illusion. The money in your account isn't sitting there, it's out in the world, powering society. Few understand this hidden mechanism, yet it shapes our lives daily. Modern banking isn't built on gold or steel, but on a promise, managed by institutions more powerful than kings. To understand, we must look past marble columns and friendly tellers into the engine room of the economy. Here, money is not a thing we find, but something we create. Pure information, digital entries, debts and ledgers. If a bank takes in £10, how can it fund skyscrapers and governments? The numbers don't add up. The real trick is hidden in the rules of the system, refined over centuries. We begin a journey to uncover this architecture, a story of how money is created and how those who control it hold the keys to our future. They built the modern world and the crises that tear it apart. The story of banking is the story of us. What do banks really do? Most think they're just middlemen, taking money from savers and lending to borrowers, but that's not the real story. Banks don't just move money, they invent it. When you get a loan, the bank doesn't transfer someone else's savings. It creates new money with a few keystrokes. That loan becomes a deposit in your account, money that didn't exist before. Almost all money today wasn't printed by governments, but created by private banks. Over 97% of money in places like the UK or US is digital, born from bank loans. The power to create money, once a state privilege, now largely belongs to private banks. The money supply isn't fixed, it expands and contracts with banks' willingness to lend. When banks are confident, they create more loans and the economy booms. When fearful, they stop lending and the economy stalls. We all live inside this cycle, a tide of credit controlled by banks' collective mood. But how did banks get this power? To understand, we must go back in time. The answer lies in the origins of banking itself. Let's see how it all began. The story begins with gold. In the Middle Ages, goldsmiths had the strongest vaults, so people left their gold with them for safekeeping. The goldsmith issued paper receipts, promises to redeem gold on demand. These receipts became so convenient that people traded them as money. Goldsmiths noticed most gold just sat in the vault, unclaimed. So, they began issuing more receipts than gold they held, lending the extras for interest. This was the birth of fractional reserve banking, keeping only a fraction of gold in reserve. The goldsmith was creating money, lending out promises not fully backed by gold. It was profitable, and it fueled economic growth. But there was a fatal flaw. If too many people demanded their gold at once, the goldsmith couldn't pay. This was a bank run. The illusion shattered, the bank collapsed. Yet, the idea spread. The goldsmith became a banker, and the system grew. The risk of collapse was always present, but so was the lure of profit. This gamble would shape the future of finance, and it set the stage for the next evolution in banking. The goldsmith's idea was too profitable to ignore. Banks across Europe adopted and refined it, but bank runs remained a threat. A new solution emerged, the central bank. The first, Sweden's Riksbank, appeared in 1668, followed by the Bank of England. Central banks became banks for banks, backed by the state. If a private bank faced a run, it could borrow from the central bank, the lender of last resort. This stabilized the system and gave governments a powerful tool to finance wars and projects. Private banks could keep creating money, but now under central oversight. The government set rules, like reserve requirements, giving the system an air of safety. In reality, the state had legitimized and formalized private money creation. Banks became pillars of the establishment, managing the nation's money supply and funding industrial expansion. By the 19th and 20th centuries, this model conquered the world. Banks' power grew. They didn't just serve the economy, they directed it. They decided which industries would rise or fall. With the power to create money, they shaped society itself. The partnership between banks and the state would define the modern era. Let's look at how the machine works today. You deposit $1,000 in a bank. This is base money, created by the central bank. With a 10% reserve requirement, the bank keeps $100 and lends out $900. The borrower spends the $900, which gets deposited in another bank. That bank keeps $90 and lends out $810. Each new loan creates a new deposit, and the process repeats. The original $1,000 can support up to $10,000 in new money through this multiplier effect. It's a cascade of credit creation. Each bank builds on the last. The money we use is born from borrowing, not from physical cash. The system is a web of promises, turning debt into currency. This is the money multiplier in action. The scale is mind-boggling, but the principle is simple. Modern banking is a machine for creating money from debt. The process is invisible, but its impact is everywhere. Our entire economy runs on this cycle of credit. Today the system is even more fluid. In many countries, banks have no formal reserve requirements. They're limited not by deposits, but by confidence and regulation. Banks lend if they believe the borrower is creditworthy and the loan is profitable. When a bank grants a loan, it creates new money instantly. Loans create deposits, not the other way around. The bank finds reserves later, if needed. The main limit is capital requirements and the central bank's interest rate. By adjusting rates, central banks influence how much money banks create. Commercial banks, driven by profit, have the public power to create money. Their lending decisions shape where money flows and where society grows. They are not neutral. They actively shape our economic destiny. The power to create money is a privilege with profound consequences. This system is inherently cyclical, creating booms and busts. When banks are optimistic, they lend freely, creating new money and fueling economic booms. Asset prices soar, businesses expand, and everyone feels wealthier. But this expansion is built on debt. When confidence falters, due to rising interest rates or risky loans, banks tighten lending. The flow of credit reverses, money supply shrinks, and the economy contracts. Asset prices fall, debts become unmanageable, and defaults rise. A vicious cycle pulls the economy into recession or depression. This isn't a flaw, it's how the system works. The 2008 financial crisis was a perfect example. Easy credit fueled a housing boom, then defaults triggered a global collapse. Banks stopped trusting each other, credit froze, and the world plunged into crisis. The same machine that creates booms also creates busts. The cycle repeats with real consequences for everyone. This cycle isn't just theory, it impacts real lives. During booms, bank-created money flows into assets like property, driving prices far above wages. Home ownership becomes out of reach for many, forcing young people into lifelong debt. The system fuels inequality, benefiting asset owners and leaving others behind. When busts hit, people lose jobs, homes, and savings. The 2008 crisis left millions unemployed and dispossessed. Shattered lives, not just numbers. Banks prefer lending against existing assets. So money flows into real estate and speculation, not innovation. The economy skews toward finance, not productive enterprise. Globally, institutions like the IMF and World Bank use credit as leverage, imposing conditions that can trap nations in debt. The power to create money becomes a tool of influence and control. Economic sovereignty can be traded away for access to credit. The secret of money creation is a secret of power. We live inside an architecture of credit created by private banks. It's financed progress, but it's unstable and concentrates power. Is there another way? Some propose full reserve banking. Banks can only lend what they have. Others want sovereign money. Only the state creates new money, spent for public benefit. These ideas challenge the foundation of our financial world. New technologies like cryptocurrencies offer decentralized alternatives. Central banks are exploring digital currencies, which could bypass private banks entirely. The future of money is being contested. Our system isn't natural, it was designed, and it can be redesigned. The real question: do we have the will to build a system that serves the public good? Because how money is created will determine everything.